People think a credit score is a judgment, a number that says whether you're responsible, mature, trustworthy. It feels personal. But your credit score isn't a character report. It's a probability calculation. It doesn't ask, are you good with money? It asks, how likely are you to miss a payment in the next 24 months? That's it. And once you understand that, the whole system starts to make sense and stops feeling like a verdict on your life. I'm Bids, and this is Break It Down Simply. Let's break it down. A credit score is a statistical prediction model. It uses your past borrowing behavior to estimate future risk. Think of it like weather forecasting. Meteorologists don't judge the sky. They analyze patterns. If certain clouds appear, rain becomes more likely. If certain financial behaviors appear, late payments, high balances, short credit history, the model predicts higher risk of default. Your score is simply the output of that model, not your intelligence, not your ambition, not your work ethic, just risk probability. Before credit scoring existed, lending decisions were deeply subjective. Banks relied on local reputation, personal relationships, and, frequently, personal bias. Whether you got a loan often depended less on your finances and more on who you knew and what you looked like. In the 1950s, a company called Fair Isaac began building mathematical models to standardize those decisions. The goal wasn't fairness in a moral sense, it was consistency at scale. Lenders needed a reliable way to evaluate millions of applicants quickly. So they built algorithms trained on historical repayment data, looking for patterns that predicted who would pay back and who wouldn't. The system worked, it spread, and it became the infrastructure that controls access to credit for nearly every American today. So let's walk through exactly what feeds into your score. Step 1. Payment history. This is the single largest factor, accounting for roughly 35% of your score. Did you pay on time? The model doesn't care about the dollar amount. It cares about the signal. A missed $40 minimum payment looks identical to a missed $400 payment in terms of the pattern it creates. And that pattern can follow your report for years. Step 2. Credit utilization. This is how much of your available credit you're actually using. If you have a $10,000 limit and carry a $9,000 balance, the model reads that as compressed breathing room, higher risk. A good rule of thumb is staying below 30% of your available limit. Not because 30 is a magic number, but because it signals that you're not relying on credit to survive. Step 3. Length of credit history. Older accounts show longer patterns of behavior, and longer patterns are more reliable predictors. This is why closing your oldest credit card, even one you barely use, can drop your score overnight. You're not being punished. The model just lost its longest data set. Step 4. New credit and credit mix. Opening multiple new accounts in a short window signals financial stress to the model. And having different types of credit, cards, auto loans, a mortgage, gives it more data points to work with. More data generally means a more stable score. The biggest misunderstanding people have about credit scores is that they measure wealth. They don't. You can have significant assets and a poor score. You can have a modest income and an excellent one. The score measures behavior patterns, specifically borrowing and repayment behavior, nothing else. The second mistake is treating every point fluctuation like a crisis. Your score recalculates constantly and moves like a slow-moving stock price. 5 points in either direction rarely changes what you qualify for or what rate you receive. The real leverage isn't in tracking the number. It's in building the habits that move it structurally over time. Here's what actually moves it. Automated minimum payments so you never accidentally miss one. Keeping balances well below your limits. Leaving older accounts open even when you're not using them. These aren't hacks. They're just the patterns the model rewards. Consistently, over time. Your credit score is not judging you. It's predicting behavior. And predictions change when patterns change. That's entirely within your control. Next time, we'll break down how the residency match actually works, and why a process that determines where doctors spend the most important years of their training feels random when it absolutely isn't. Until next time, keep it simple.